Good afternoon, everybody. I'm Dan Hussey with Zaner Ag Hedge. Welcome to the Strategy of the Week webinar. Um, Really, I think today is going to highlight a lot on the soybeans. I think we've seen a pretty impressive close to the week and a good enough move higher off of the lows so far to maybe start considering this a harvest low. If that's going to be the case, it's probably a good time to start looking at the upside, how we can best tackle that, and then some of the levels to look at maybe with even buying futures on the dip or um, taking a look at a couple option strategies that one, not only was I pricing out this week and a call spread, but then also some other ways that into next week it might make sense to start looking at the long side. Okay, so let's begin with our daily chart up on the screen right now of November soybeans. We've got a pretty nice capitulating low here on that dip below $12. The 200-day moving average trading at 1285. We got that 55-day moving average coming down here just above it, that blue line at 1290. Looks like we could get a crossover there. 100-day moving average up at 1324. That 18-day moving average, probably our first resistance. I would look for this market to get back up to test. That's at 1248. But generally speaking, this market has, really pulled all the way back into that congestion zone right around $12 that we've been talking about. Taking a look at its 4-hour chart now, because we've kind of watched and waited for this market to do just this. We finally broke and had some capitulation, in my opinion, down towards that landing zone that we've been talking about, the 18 or $12 to 1840 1140 area. The 1180 area is where I'm getting 18 from, but 1180 area that this market has now bounced from was the 100% or that equal legs extension. If you measure from 1480 down to that 1240 low, extend that from our range highs from this summer, that was at 100% move down to the downside. Now, there's a downward sloping trend line against the highs of this chart. It comes in around 1260 at this time. That'll be a big area for the market to have to chew through if we get up there. There's also this confluence of supportive zones from both June and September right around the 1260 area. That's broken support. Now would be resistance on a bounce back up. So we'll continue to watch for as this move, off of our seasonal low now starts to, and the swing low starts to begin. We're going to be looking for that to the upside. Now, 1220 here trading today was a pretty critical level. That puts us back into pre-WASDE report range area, and that's a pretty good bounce and move higher so far for soybeans. The question is, of course, whether or not we're going to see that follow through now, because 2 days up off the lows and certainly a outside day reversal to the upside today constitutes a good reversal signal. We have had 3 days now of outstanding export sales, those flash sales that we've been looking for to come in and confirm our conviction that the market's going to find a seasonal low and that this is going to be a demand-driven market. That's what we're starting to see now from the fundamental side of this trade. So it's good to see 300,000 plus metric tons a day of soybean sales to China averaging the last few days, and 54 million bushels total sold. That's 1.5 million metric tons total in flash sales in the last week alone. So that's a good start to the export season. Downward sloping trend lines against the highs on this most aggressive chart here. That was the level we broke out from overnight here and into this morning. We've traded now higher to recapture the low end of the range from our WASDE report day. We have another downward sloping trend line that comes in right around 1225. I don't expect to see much resistance here, 1220 to 1230. But once we start to get towards the 1230 to 1260 area, that will be, I think, an area of congestion on this chart that's going to maybe take a little bit to chew through. So how do we best tackle getting long the soybeans now that we've not only had the capitulation, had that drop down to new lows that we were looking for in the harvest time frame? We've started to now see the export sales that support the trade fundamentally. We've got a technical reversal, right? Yesterday's price action was an inside day here. inside that prior day's actual low. Today we have the outside day to the upside, so we have that technical reversal and starting on a chart. We're certainly below all of our moving averages, meaning that we should possibly see some kind of reversion to the mean back up into those levels. And those are, the levels we talked about here earlier in the chart. And we've got a lot of technicals, some very visual downward sloping trend lines that probably need to get tested again as resistance. So all of that being said, the downtrend seems like it has come to a close. Seems like we're starting to take that first step to the upside. The first strategy I was looking at was because I'm a little fearful that our November contract might not have enough time to really see things to fruition, to see us back above $13. So I went out and I was pricing out through January here. We were pricing out the 1250 or 1260 call. Let's take a look at that one first. Go out to our January expiration here. That 1260 call right here, or 1250 call, you're talking about a 21 to 25 cent cost. Outright, that's not a bad option. It's, you look here, January beans got off the board at 1226. You're within 30 to 40 cents of being in the money there. So you've got a pretty tight to the market strike that has a high probability of success just from its proximity to the market. You are paying 21 to 25 cents, so you're going to need to see the market get up to 1275, 1285 to see profitability on this type of option. But a move back towards $30 or $13 over the next 69 days, which is how much time is left on the January options, is possible. And if you do get there, okay, well now you're talking about potentially doubling or actually making your money back and then some, a profit on top of that cost investment. Now, we were cutting down on the cost of these options by selling your 1350 or 1360 strike, turning it into a dollar wide spread, so you could still get a full dollar out of this option strategy of potential income. Against your total cost, however, at about 16 to 18 cents, that's going to come in with a cost average of, a risk reward ratio of better than 5 to 1. But you're also going to be potentially making 80 to 85 cents of pure profit if the market goes above 1350 or 1360, the strikes that you'd be selling in this call spread. So again, that's buying 1250 or 1260 calls, selling 1350 or 1360, depending on your risk tolerance here. You can save 4 cents there by doing a 1360, 1260, 1360. But at the end of the day, you are, of course, 10 cents further from being in the money. I chose these strikes because I think that we've got a high probability of landing in the money and even exceeding that 1360 cap on the trade, that the strike that we sell, but which of course we hate to see happen because we'd love to make more than that. But the truth is that if you want to have an aggressive means of seeing over the next 70 days if the beans can rally a dollar and you only want to risk less than 20 cents, this is a great way of pretty much getting as much out of that trade as you're going to get. Because there's other risks involved, right, in holding futures. You have to deal with intraday volatility of 20 cents at a times of market swinging to and fro. So using a call spread at this time where we're kind of planning a little bit for being wrong. That short call is in essence a bet that we are a little bit wrong, and we're willing to take 4 to 5 cents in call premium to do so by selling that call. So, all day here for a strategy with 70 cents, 70 days, left on it. We can get better than 5 to 1 risk reward ratio right now, still buying calls here. Again, that's the 1260, 1360 call spread here in the January beans. Anything further out than that, I definitely think it needs to be a call spread just to sell some time value. But this is the type of strategy where you can come in and reassess come the new year, because this January option does go off on Christmas Eve, actually. So you come in here into the new year with a fresh mindset and a new strategy if this one doesn't work out. But I think there should be, based off the charts and what we're seeing here today, there should be a move in the near term to the upside and we'll see if that continues here going forward. So again, that's just one way of getting into this market right now. I don't know if you want to play very aggressively in the November options. November at the money calls though, we're going for about 10 cents there and into the end of the day. That's the 12:20 call. So if even with 7 days left on it, which is basically just next week, right? Because a week from today these go off the board. Um, if you wanted to play in at the money option here, it's a 10-cent cost, and so that might beat the pants off of the risk profile of using a futures in this market if we're only planning on being in the trade for a week or so. But that 10-cent cost could also be a reason to buy a future and turn around and buy that put. You can have a complete risk floor in at 12.10 on the board by buying a future here at 12.17. You just say you bought it at 12.18, 12.19. You use that 12.20 put at a cost of about 11.5 cents right here. The 10 cents risk from the market, or the risk between the market and that put strike plus the cost of that gives you your out the door complete risk on the trade. So now all of a sudden, instead of spending that 10 cents on that call, you can have the positive delta of being long a futures contract that you really only need 11 cents to make up for. And then everything above that is a pure delta of one profit, but having finite risk the whole time of being able to, again, buy a futures here in these soybeans, but use a November option. Again, it's a stop that's only good for the next week, but it might keep you from getting stopped out at using a 10-cent stop, where the market would go down, hit you. Now you're completely out of the market. Using a 12.20 put like this, the market could go down 40 cents and rally back 70 cents the next day. You could have made that 30-cent difference to the upside, but instead you would have been stopped out by that 40-cent drop. That's where I think the value in using options lies as a protective risk strategy, is using and cutting down on that time value. So again, while we approach November's expiration, why not use that to your trading advantage? And instead of taking a futures position with a stop loss, you can very cheaply get the same type of day trade strategy or the same type of short time frame strategy by using an option to manage the risk rather than a stop loss. Get the same kind of risk profile. The only difference is that you can't get taken out of the trade until that option is actually exercised next week, which gives you time and a probability. It might be small, but still a chance for the trade to work out in your favor. So again, in the near term right now, the first strategy we're coming in though to the market for the beans as we are watching a low develop here for us is those call spreads, specifically somewhere in the January timeframe, right around that 1250 to 1260 area is the calls I like to own. I was selling 1350, 1360s, turning it into a dollar-wide call spread, doing that between 16 to 18 cents. Yeah, like that idea going forward. So let's take a look at December corn now and take a look at that big old daily chart of December corn. Impressive how range bound we are in today's market, snapping back off of lows of the day to trade 10 cents higher here to go out above 520 again. Really can't spend much time below the 200-day moving average at 519 there. We're coming back up. Today's resistance was the 530 area. That's 18-day moving average. The 55-day just above us at 537 and the 100-day above that at 547. Got a few levels to chew through for December corn on the way back up. Let's take a look at that 4-hour chart because we are, interestingly enough, kind of starting to poke our head back above and through a trend line here on the near term. I like the way this chart's shaping up. The things I don't like about this chart, however, are some of the 50% levels that are holding. 547 highs to lows of the month. We basically tested up into that 50% retracement. That could be a resistance level here for December corn we need to be aware of that we just traded back up into. The full 50% retracement from 594s down to the 497 lows. That 545 50% retracement has already traded. Granted, we broke the trend line off that area, so we could very much be in a range here between $5 and 5.45. But we do have this 5.25 to 5.20, 5.30 resistance zone now holding that we really need to be aware of. Let me get rid of some of these smaller intraday levels. Sometimes I wish I could show you guys how I measure and do stuff, even down to the smallest time frame. But it's way too much to cover, and I'd have too many questions. So for right now, it looks like this market is very technically bouncing between these fib levels, respecting $5 to the downside, and still very much range bound. But reversion to the mean now should suggest the fact that we've had so many tests of this $5 level. Reverting to the mean here, we should test back towards that 550 area and maybe even back towards the middle of our larger range, because at the end of the day, that's all we can say corn has ever been. It's just been a range here above $5. So that's something that I think everybody can be very happy about. Now, corn is a market where I almost am starting to prefer owning futures over call spreads. The reason being is that we've actually started to really get tight in the market, and there isn't much volatility to sell up above the marketplace. In other words, as the market has gone sideways, all that volatility premium that builds up in options, particularly ones for call spreads that we like to sell, options above $6, as we'll look at here in a minute, don't have much opportunity to utilize and tap into that option premium to try to take something out of the market. Um, like as you saw in that last strategy, selling 1350 calls in the soybeans, we could only get 4 to 5 cents for something in that area. Um, I'm sorry, go out to your Jan contract here for corn, go up to the $6 mark. I can only get 3 cents for selling a $6 option and just about nothing for anything above there. I have a pretty good strong conviction we'll go back to $6 in corn, so I'd almost rather not sell options up there to bring in that premium because there's nothing there. Even going out to the March timeframe, add on another 70 days, the $6 call is only bringing in 8 cents. Now that's not bad. That's better than the 4 cents we were looking at before. But we can only get about 4 cents for a 640 or 650 call. Look at what the 550s. Turn that into a dollar spread. We're doing this for about 16 to 17 cents. So I can get a dollar wide spread in the beans for about the same price that I can get a dollar wide spread in the corn. The corn spread is only 15 cents away from the market, and the bean spread is about 35, 40 cents away from the market. So, you tell me. I think I'd rather spend my money on the beans one. Higher volatility there. I think there's more ability for the market to move to the upside. So my point here is that it's almost worth just owning, I think, outright corn calls, or just own futures and then buy puts against them if we're looking for an upside strategy here. Own futures and buy puts against that position to try to do a little bit better, right? And have positive delta that can keep you in the marketplace. And the delta I'm referring to, everyone, it's the idea that owning a futures position has a delta of 1 or -1. If you're short, it's -1. If you're long, it's +1. Delta of an at-the-money call or put is 0.5. So half that, or -0.5. So you need two puts or calls to, in theory, cover the outright daily option pricing change against the futures. However, if you were just worried about the level as an outright risk level, like the strike, it is a 1-to-1, one contract of futures equals one contract of an option if they're in the money. So that delta shifts and changes as the closer you get to expiration and to strike. That delta goes up to eventually. The theory is that in the money options on the day of expiration are trading with a delta of 1. And they have effectively no other they only have their intrinsic value is what that means. And it's The idea is that every day holding a futures position that goes in your favor with an option against it, the option will ever be losing less and less money against it. So you always have a delta skew to the future side because it's always got more power to move for you or against you in the marketplace. Okay, so without getting too far off of topic here, in the corn, you could stick with the December contract, but the truth is that Man, we're going to get real heavy here on the corn for a second. Talk about some spreads, because I think there might be some opportunity in some spreads here for corn, to maybe look at to really maybe look at. The question here is, do you want to be long new crop, old crop? If you look at December 22 corn, we were making new contract highs there when December 20 corn was failing to rally. We've seen this bear spreading going on in many of the corn spreads. This happens to be the March 22 to November 22. Let's bean spread. I would like. Let me get my corn spread up here. Want the March to December, March to May. That's close enough. March, July, here's better. Here's March to December. Should be trading at, there it is. So this chart, negative carry here on this March to December is down somewhere around like 80, or the carry. So we're building that carry into this chart. We're expecting the market to continue, to continue lower here, in this downtrend. We're obviously though going to get these spikes up on it, and those are really usually this time of year would be indicative of like your March contracts being bid up and the fear there won't be beans, until and or corn in this case, right? Because it'll all be gobbled up by export markets and what have you. But continuing to build carry into this chart is probably what's going to happen over the next several months. Now there will be pops, back to 20 and 40 cents over perhaps, where we will be looking to bear spread it. But while this bear spread is intact, it would make more sense that if we're going to be getting along the marketplace, along the market, it might make sense to do so during, via a spread. Whether that means going all the way out to December 22 corn of next year, and starting to position there, or does it mean potentially bear spreading and having a position on in the March to December spread, and then carrying with that a front month futures position in utilizing options. That's, I think, the strategy I'd be going for. So the idea is that the putting a bear spread on, okay, in other words, selling the March 22, buying the December 22, we are in essence looking for the market to continue lower in price in some capacity. However, we're wanting carry to build into the marketplace, and that's something that chart would be indicative of, going lower. However, we just acknowledge the fact that there could be some regressions or some, pops against this trend as we trend lower. We'd expect it to retest broken support as resistance. And honestly, anytime we have a massive or a very strong up move in front month corn futures, we're probably going to see some bull spreading happening in these carry spreads. So we're going to be looking for an option strategy taking us maybe through the March timeframe now, that will have us long the market, while in the back we'll be ready in bear spread for that carry to potentially come in. So with all that being said, if we've got a good bear spread on here between 20 to 10 cents over here in corn futures, the March to December future, again, for next year, that opens up the door for us to then come in, and by the way, reduce some of the margin to carry that spread as well by owning the March time frame here options. March trading at 534. We can own a 550, $650 wide call spread for, and again, this is 15 cents out of the money. We just talked about this, for about 16 to 17 cents. It costs about 20 cents to buy that 560, to buy the 550, excuse me. It costs about 20 cents, and we'll bring in about just shy of 4 cents for that to sell that 650 there in the March as well. So we then have the ability to make $1, about $1 or up to $1 of this move higher in corn if it happens, but all the time maintain that spread trade, and honestly kind of use the gains on the call. In my opinion, the gains on the call spread that you're doing here would be used to potentially offset the losses on that bear spread in the back. Although there's no guarantee you'd see it perfectly, but more than likely buying vol in this type of capacity would benefit that. Now, you need to obviously be aware that that spread could move further than a dollar against you, but nevertheless, it's going to give you time, margin reduction, and the ability to honestly play both sides of the market through a certain period of time, right? We are bullish through March. Then once we get through that time frame, things might settle down and we might start to build carry without some kind of weather scare. That's what happened last year. If we go back to that spread chart and you look at what time of year there, markets really topped out for the spreads. It was back in that June time frame. So once we got into through planting season, right, and started into the weather markets of the summer, we didn't have enough of a weather market for this market to break out and continue in the massive inversion it was, and we just started to build carry in. That building of that carry into the market was one of those big reasons that we remained somewhat bearish over the last several months. We've been looking for the market to have that capitulating drop here during harvest pressure time frame, and we needed to see the market move into a new cycle because we've exhausted the old talk and the old reasons for being fearful over supply. Now the only thing we can worry about is demand, and that's what we're seeing the market have an argument over today. Flash sales from China for soybeans, great reason to revigorate the bulls here, to get a reason for this market to potentially head higher. From a fundamental standpoint, we've got the demand there and the demand equation being answered. And the only other, usually the solution to that is price rationing in some capacity, which, yeah, hey, we're not there to price ration back to, $15 beans, but okay, going back to test to see if we shouldn't be beans in the teens still is probably going to be one of those dynamics that happens. But so in the near term, March 22, December 22 corn, we're looking to keep a bear spread potential position there. That will help us build carry in a market where, in that, again, that March side of that equation can roll forward, but in the same time, picking up an option strategy here closer to the money. I like having the 550 calls. They're 15 cents of the money for March 22 corn. And we're selling the 650 calls against them, just bringing in something, having a dollar wide call spread for about 16 to 17 cents cost. And that gives us some protection against that bear spread we have against really trying to hold a December 22 long corn position. So, well, that pretty much wraps it up for me here today. Just, I guess, some real quick look at wheat markets, maybe a quick look at the livestocks too. I don't have much to say about wheat. It seems to be in a very big range-bound market. We have 50% longs from our 676 lows to the 763 highs. That 50% level around 720 is holding. Draw the 50% short from the highs here recently to lows. Well, that 50% short around 740 is holding. So I think we have a bit of a fight over the trend here. While we're above 710 and below 750, I think there's going to be a 40-cent dance with the devil there for wheat. Lean hogs had a pretty strong day here for December futures. We had a bit of a gap up there on the open. Inside price action holding, trying to keep this gap from filling here at 77. I think if that continues to hold, we break above this trend line here, get back above 80. This market could easily, I think, turn higher and have a decent run higher here if it can reestablish itself. Live cattle, though, I think very impressive close here to kind of end the week. We had a push back up into this 131, 50% level off the highs. We're closing back above that congestion zone formulated from the lows of July. The highs here for mid-September, we're back above those levels. We're certainly, I think, holding some kind of trend line here off the lows, some kind of new trend line, and a full 50% retracement from contract lows to highs here. Arguably traded or held some kind of nice support here. Again, it was that old congestion zone from earlier this year, held as support. We're getting a reaction. We push above 132 to 133. Maybe we'll get some momentum back to 138. We're seeing some strong cash pricing across the Midwest. Box beef cutouts seem to be stabilizing somewhat, but again, a demand-driven market that we need to see the demand pick up there to continue at this pace of a kill there for the live cattle as well. So the big news today for me was the sizable and very, very worthy of note flash sales there from China and out of Asia. Well, unknown destinations, assuming all from China this week in soybeans. That's the demand market kicking back in and something we're going to really want to see continuing going forward. So, all right, everybody. Well, have a great day. Have a great weekend. We'll be back with you next week as price action develops. Of course, you can always catch me over here at Zaner at 312-277-0110. We'd love to talk with you in more detail about putting some strategies and some other ideas together for you. Over this next week, I'm probably going to start to flip my hat if we continue higher in the beans to becoming a little bit more bullish, looking at more futures positions to come in on the market at. But again, I think call spreads at this time are pretty good places to start that off. Join me every week here on my Strategy of the Week forecast. Check out Dan SOTD on Facebook to get all my Strategy of the Day recaps. Have a great day, everybody, and we'll be back with you as price action develops. Remember, trading futures involves risk and is not suitable for all investors, and everything I've talked about here today is just my own opinion and not a direct trade recommendation.